So I guess you can see my slides now.
Yes.
Oh, perfect. So the topic is India's growth story and contemporary challenges. And it is high time that we discuss, or maybe should I say this is all we seem to be discussing in the media at least, India's growth numbers. And rightly so, it is a very important parameter to judge a country's success, whether it's economically or socially, or for that matter, even politically. So the presentation that I have today is based on some of my previous work, um, and it will try to address, or it will try to focus on these following sets of issues. When we talk about growth or any other short-term development in the economy, I, for one, like to step back and look at the medium term so that I can make better sense of what's happening. Let's say this month, or the inflation data last month, or whatever else you may have. So in a paper that I had done with my colleagues about 2 years ago, and again, the challenge was similar. How do you make sense of contemporary growth trajectory? We decided to look at the past decades of experiences. And doing so, we ended up looking at nearly 5 decades of data. So we started our analysis from 1970, and the reason being data availability. And prior to that, it's patchy. And we documented a few stylized facts on India's long-term growth and what kind of structural shifts have been happening. And while doing so, we realized that there have been, at that time, 2 years ago, there was only one phase of growth slowdown. And that phase started after the global financial crisis of 2008-9. Since then, in the last 2 years, there has been another slowdown, which is pre-pandemic, which is in the last 2 years, or some would say three, but I'll talk about why I think it's 2 years. And the questions have been whether the slowdown should be called structural or cyclical. I did attend Dr. Ratin Roy's presentation yesterday when he was dismissive about this distinction. But let's see whether we can explain it a little bit better and understand it a little more. Another question is whether it's external or domestic. For therein lie the policy options. If it's external, then it has to be treated differently. If it's domestic, then of course an appropriate domestic policy response is needed. Since then, unfortunately, the world has been hit by this, as Dr. Singh said, unprecedented event, the pandemic, and a lot of questions. And as I will mention, I think everybody needs to be a little bit modest about this event. There's so much we do not know about it. We do not know whether it's a temporary or a little bit lasting event, and what kind of policy matrix will be needed. So during my presentation, I'll also try to talk a little bit about the policy framework, the overall policy framework. So when you talk to economists who specialize in different areas, you may hear from a financial economist that financial sector needs to be recapitalized, a lot more money is needed. And somebody else would be saying that the government needs to spend much more money, put money in the hands of the people. And a third would say there is no fiscal space. And all of this is true, right? So I think it's important to keep the bigger picture in mind. If you just hear the financial sector expert, you may come out thinking that if we recapitalize the banks, things will be just fine. Or if we give out more money, things will be just fine. Unfortunately, it's harder than that. And if it wasn't, then we would be seeing many more countries being richer, just putting the money where it's needed. Unfortunately, policymakers do not have that luxury. So with that, let me go into addressing some of these issues that I said I would be talking about. And the background work on which my presentation is based includes the India's growth story paper, which I just mentioned, an op-ed I had recently written for the Economic Times. World Bank produces reports on the Indian economy. We try to do it twice every year, but we have managed to do only 2 in the last 3 years. These are called India Development Updates. And a recent paper which I've just finished on inflation targeting. And I would have loved to present it, but I don't think I'll have the time. So if there are questions, I'll be happy to take it. And I'm also happy to return to present that paper if it's of interest. So scope of the presentation is a little bit limited in the sense that it's mostly macroeconomics. Unlike Dr. Ratin Roy, I will not be talking about the political economy a whole lot until we come to the reform priorities and challenges. Rather than focusing on the short term, I like to look at a more medium to long term framework. And I think that gives richer explanations and is also important to appreciate the policy space that one is working with. So long term gives me that flexibility. One thing we need to keep in mind is that whatever policies we talk about as far as the macroeconomics is concerned, they need to be inherently consistent with each other, and they need to be sustainable. And we'll be talking about sustainability in a minute. And overall, I feel that increasingly so, we the economists need to be humble, objective, and we need to be modest about what we don't know and what we don't. Let's not claim more than we know. These are challenging times, and as I say, talk is cheap. But where we don't know, we need to admit that we don't know something, and it needs further analysis. So now, looking at the data that we looked at, so 2 years ago, when economy had started slowing down, scenario was doom and gloom as it is now. But when we looked at the data for the last 5 decades, we realized that India's growth experience has been nothing short of exceptional. So growth, not GDP, growth has accelerated slowly over the last 5 decades, over a half a century period. And there are only a few precedences among developing and emerging countries where growth has accelerated like this. East Asia clearly is a region where growth has behaved like this. And India, of course, has aspired to grow in a similar fashion, not just in the levels of growth, but also its sectoral decomposition. But outside of East Asia, you don't find many examples, contemporary examples, where growth has consistently accelerated like this. Another thing to notice from this chart is that as growth has accelerated, it has also become more stable. So in the 70s and up until the 1980s, there are lots of ups and downs. And now those fluctuations around the trend growth rate are much more smaller. So it's not just the acceleration, it's also the consistency, which is important. And the consistency can be explained in some ways. And population growth, meanwhile, has been declining, which means that real per capita growth has accelerated even faster. I'm just trying to minimize this. Okay, perfect. So looking at different sectors of the economy, in agriculture, as you can see, the trend line is flat, which means on average, agriculture has only grown at about 3% a year. And the fluctuations around it are much more dynamic, unlike the aggregate GDP. Which is not surprising. I mean, agriculture in India still depends on monsoons. So there are fluctuations, but those fluctuations as well have become more moderate. We hear a lot about India's manufacturing or industry sector not doing very well. But in fact, growth has accelerated in this sector as well. So the bigger point that I'm trying to make is that this growth acceleration is not concentrated in any one sector. Services clearly has been the fastest growing sector, as a result of which its share in GDP has increased, but it's not the case that manufacturing or industry hasn't grown. It's just that its relative growth is a little bit lower than services. So its share in GDP has been stagnant. Now, this is where India's experience differs from that of East Asia. So East Asian model of growth, be it China, be it other countries, and now even Vietnam, Cambodia, um, and before that other countries. So South Korea, of course. Services sector growth is a more recent phenomenon. And when India grew, services sector started accelerating at a much lower level of per capita income. And there are very interesting papers on this. And for those who are interested, I'm happy to give the references later. There is actually an interesting paper by Raghuram Rajan and his co-authors at the IMF trying to explain this phenomenon. I have worked on this issue as well several years ago. We don't talk about it as much in the economic discourse these days, but it has been a very interesting and important question. This acceleration is also not confined to just a few states. And in fact, in this chart, what we are doing is we have state level data, and we are trying to look at the growth in the last decade relative to the growth in the 1990s. And as we can see, most of the states are above the 45-degree line, which means except for a few, most states have grown faster. The relative growth rates and relative accelerations differ, but overall, this average acceleration is seen in almost all the states. Another way to look at the quality of this growth is to ask whether it was only consumption, which will be unsustainable, or whether it's excessive investment, which was the Chinese model and which used to be earlier criticized, that it's all being underpinned by very heavy investments, irrespective of their quality, and therefore the model may not be sustainable. Or is it all external demand based, which again is highly dependent on how the external economy is doing. And in our work, we see that again, it was balanced during this period. The share of consumption in GDP has declined, as it does when economies grow richer. And the share of investment and exports increased for most part, explaining this acceleration in GDP growth. Investment and exports, however, have come under pressure since the global financial crisis, as I will talk about just in a minute. Yet another way to decompose this GDP growth is to look at the contribution of factor inputs and productivity growth. Again, the concern being similar to that of excessive investments. So if it's all because of further input use, but a country is not producing productively, then that growth may not be sustained. In the Indian case, we find it's a fine distribution between the factor inputs and productivity growth. So overall, we came back feeling quite positive from this experience and this analysis of long-term growth. The next question is, how do we explain it? And here, some bit of work did go into thinking about it. Doing it econometrically is not very feasible. I mean, you can do it, but purists will not be happy with the kind of regressions one can run with the available data. So what we also did was we looked at the report of the Growth Commission that was set up, I think, nearly a decade ago, if not longer. And we looked at some of the correlates of growth that the growth model that they put out had talked about. Or we relied on the wider growth literature to look at the correlates of growth. And so this, again, not econometrically heavy, but decent analysis showed us that there are a number of things which can explain India's mostly favorable growth experience. Its large population base and its positive demography, which actually Professor Mehrotra cautioned us is going to turn around. I think he said in about 20 years. But so far, and in the past, India's population base has been large. So a large consumer base, a large base of labor input, favorable demography, skill enhancement. It's a very large market as well. So, India can do better if it can leverage the external market. But for some part of the growth, its own market is so large that it need not be overly dependent on the external market. So I'm cautioning myself while saying this because Professor Arvind Panagaria has recently written an op-ed, I think just earlier this week, where he has mentioned that based on the domestic market, we can grow a certain percentage point. But if we can also leverage the external market nicely, then we can only accelerate our growth path. So I'm not in any way discounting the role that the external market can play. All I'm saying is that India has a large market, and in the past, its international integration has been limited. So this growth, to some extent, can be explained by its own very large domestic market. Its economic base is diversified. So here, I think it will be useful to look at other countries which rely, let's say, on only one commodity, and we call them, or a few commodities. We call them natural resource-based economies. These economies, because they are not diversified, their growth is heavily dependent on the terms of trade that they face. So, for example, you can look at the oil-producing countries today. And with the crash in oil prices, their economies are in serious trouble. So the comparison here is that India, because it has a very diversified economic base, and we just looked at that it has a decent manufacturing base, services, both non-traded services and traded services, and it does not depend on natural resources. So that economic base insulates it from many different kind of shocks. And that can explain some part of how India has done well over the past so many years. Then it's a large federal country, and it has states at different levels of income with different comparative advantages, which can provide the needed skill, capital, entrepreneurship, and which results in very robust internal trade and factor mobility. Again, it's like a continent in itself. So think of European Union. So in a way, hypothetically speaking, we have our European Union right here with a common currency. So all the benefits that European Union wanted to cultivate from integration, we have it here already. And very important, a prudent macroeconomic framework. We did have a crisis, a balance of payment crisis in the 1991. And there are countries which, after one BOP crisis, go through multiple crises. And there are countries in Latin America which have done that. And that's because your macroeconomic framework is not sustainable. And what do you mean by macroeconomic framework? I'll come to it in a minute. And it's important to keep in mind that when you're dealing with a shock, and there are imperatives to actually increase your fiscal in an unlimited way, but you also want to shield yourself against any kind of external crisis. And India has managed to do that. So we did have a BOP crisis in 1991. The opportunity was used to reform widely, and which put us in a stronger position. And for most part, except for a few years after the global financial crisis, our macroeconomic framework has been prudent. Institutions and political stability, again, here the comparison is not in a time series sense, but with other countries. So here, I think the comparison would be with Africa, right? So one can talk about what kind of institutions does an average African country have, or political stability. So, so for different parts of these correlates, you can draw examples from different parts of the world, and you can see how India has done relatively well on many of these parameters. And there is an undercurrent of reform story through all this. Now, when we look at this entire 50-year period and we break it into smaller periods to understand whether there have been sub-periods of growth or deceleration, then we see this picture. So during the 70s and for most part of the 80s, average growth rate was about 4.5%. Annual average growth rate was 4.5%. In the 90s, until the early 2000s, this growth rate accelerated to 5.5%. And it's a very decent acceleration. Then there was a short period prior to the global financial crisis, which happened in 2008-9, when this growth accelerated to nearly 9%. And so it was, as you can see, a very steep acceleration, but it only lasted a few years. And it's anybody's guess what would have happened if global financial crisis had not occurred. Would we have continued on this same path of 8+ growth rate, or would there have been natural dampeners on growth? We don't know. But the fact of the matter is that growth did dip, I think, to about 3% in 2009, and then it rebounded to again nearly 8-9%, and the average growth rate since then has been 7%. And notice that the data in this chart is till 2017, and since then 2018 growth has been about 7%, and there have been 2 years of much slower growth rates. So the point to make here is this heavily accelerated growth of nearly 9% pre-global financial crisis, and it coming down to about 7% post-global financial crisis. So how do we explain this rather unusual or very rapid growth acceleration during 2004-8? There has been work done on this period, and I think the best reference that comes to my mind is are a couple of papers by Dr. Rakesh Mohan, who was into policy making at that time, and he tries to explain this growth acceleration. And my interpretation is what is on the slide here. So a number of things were going right at the time. Global environment was highly conducive. India had started integrating in the global economy, both on trade as well as on capital side. In fact, it was a period of golden growth, not just for India, but for the global economy. And I remember reading papers about, Africa as a continent growing at 5%, and people talking about a breakthrough in their economic performance. It was also a period where nearly a decade and a half of reforms, which were started in the early 1990s, had started to pay off. There is a very rich history of these reforms in a lot of books and papers. And there's a book by Professor Arvind Panagaria who talks about this reform narrative. And I'm forgetting whether Vijay Joshi does the same, but there is a very rich reform narrative. So for those of us who are feeling a little bit disappointed that reforms are not going fast enough, and if you want to feel good about India's capacity to do these reforms, you can look at that period and see what was being done. It was also a period when the credit growth increased very rapidly. So nominal credit was growing at the rate of 35% a year. There was an investment boom, and there was a surge in capital inflows. At one level, these developments look good. There's nothing wrong in it. At another level, there is cross-country experiences and literature on this phenomenon, that they're not in all the cases, but in a large fraction of cases, there are times when in a country, credit, investment, capital flows increase very rapidly. Its financial institutions and the real sector is not really very well prepared to benefit from it. It can result in excessive exuberance. It can result in very fast investment, which is not really underpinned by a similar growth prospect in coming years. And as I said, a fraction of these do result in crisis. Now, this is not what happened in India, and therefore I'm saying we don't have the counterfactual. What happened in India was that an external shock happened, that was the global financial crisis. But whenever I look at this period, I'm reminded of the fact that in fact credit growth and investment growth and capital flows were increasing very rapidly. Capital flows were so large that the RBI was struggling managing them. So at that point, and I'm forgetting the exact numbers right now, so let me not venture into it, but it was, compared to India's previous record, very rapid inflow of capital. So there can be something speculative about it. RBI managed it very well for most part. But whenever I look at this period, I'm reminded of unsustainable booms that other countries go through. And I'm not saying that it would have been unsustainable in India. I'm just pointing to that possibility. So slowdown since 2008-9 from 8.8% in previous few years to 7% initially coincided with the global financial crisis. And the economy rebounded. Subsequent slowdown can be actually attributed, and it was sharper in India than in other emerging markets, to, as I said, the the extent of increase in prior years, which has been seen to be unsustainable in other countries, the specific policy mix that was adopted during 2008-9, and the reform process that just got derailed in the mid-2000s and thereafter. So this policy response is important because these are exactly the kind of discussions we are having currently. We again have a global crisis, which is different. 2008-9 was a global financial crisis. And what we now have is a health and an economic crisis resulting from the health crisis. So I understand very well the nature of the crisis is different, but the origin is external. So the policy response at that time, 2008-9, consisted of exactly the kind of discussions and policy actions we are seeing now. 2008-9 also happened to be an election year, which people have written about it, which influenced the kind of policy choices that were being made. And there is a very interesting paper by Dr. Govinda Rao, who has talked about these policy choices. So there was certainly monetary easing, and it was coordinated within the G20, and all the countries eased drastically, both through conventional and unconventional measures, which involves direct pumping of money into the economy. And it was led by the US Central Bank. There was increased fiscal spending and higher deficit. At that time, revenues didn't collapse the way they have done this time because of the lockdown. So the higher fiscal deficit was primarily due to increased fiscal spending. Fiscal deficit increased by 4.5 percentage point of GDP within a year and a half. There were tax rebates to keep the supply side going. There were farm loan waivers adding up to nearly 2% of GDP. Banking sector was asked to be lenient. So there was regulatory forbearance. There was evergreening of loans. And it has been documented in the papers I have on my screen here. So what happened in this process? Growth did rebound temporarily, but banking sector balance sheet problems started becoming apparent after a year or two. So the banking sector issues that we are witnessing now, that's the origin, 2008-9. Inflation reached double digit within a couple of years. Current account deficit increased to more than 5% of GDP, which in the last few years has been around 2%. Fiscal deficit exceeded 9% of GDP in 2010. So I alluded to a term macroeconomic stability, and I think it's the right time to talk about it. So in a very narrow sense, when we talk about the macroeconomic framework of a country, or suppose that the IMF economists go to different countries and they analyze the macroeconomic health, there's some key parameters they look at. Among them, if you just want to give an elevator pitch to somebody, how is X country doing? And that pitch can be based on just a number of parameters. Well, not really well. Inflation is about 10%, current account deficit 5%, fiscal deficit 9%, and the other person will look shocked. Really? So what are you doing about it? So this is the situation we were in. Of course, there are other things: banking sector health, public debt, how the debt is being financed, what is the debt servicing ratio, what's happening to the real exchange rate, how many reserves does the country have. So those are the kind of variables you look at. So that is the time when actually, while addressing the slowdown and the very severe shock that the global financial crisis was, macroeconomic stability was compromised. And what happened? You grew for a year or two, you managed to grow at nearly 9-10% for a year, but after that growth slowed down because this model was unsustainable. And these policies, rightly so, had to be tightened. Fortunately, we did not have a BOP crisis, and my view has been based on the work that I have done on capital flows, that India is under no risk of a BOP crisis of the kind we have in 1991 or what many other countries go through because of its very cautious approach on capital flows and its very large reserve base. But even so, in 2013, there was a mini episode, which is known as the tapering episode, when the pressure did build up on capital flow. And in our paper, Barry Eigen Green, Kaushik Basu, and I have looked at that episode. We do point out at this compromised macroeconomic stability being the reason why India felt the pressure of the capital on its capital account. Now that I won't go into it because that's subject material of a full talk, but let me go on from here. What else happened after the 2007-8 crisis? So some drivers of growth actually became weaker. So when I mentioned that pre-2008-9, investment in credit was increasing far too rapidly, we do see it in the data that savings and investment rates increased to nearly 35, and there were papers being written that finally India has the investment rate of East Asian countries. But as we know now that it did not prove to be durable and after the global financial crisis. And credit growth again increased very rapidly, but has slowed down since then. So some of the slowdown that we have seen, its origin is in 2008-9. But what is really worrisome is that those trends haven't reversed durably. So as you can see on the chart on credit growth, it had started increasing, but remains subdued, and the banking sector remains under a whole lot of pressure even now. Another interesting thing is that India had started integrating very well in the global economy. I mean, the exports to GDP ratio was only about 7% in 1991, and it increased all the way up to about 25, and now it has been declining. And the recent data, I think yesterday only a data point has come out that exports are not doing well even now. There's a global story as well behind it. Trade around the world has slowed down. A number of papers have been written down around it. And the slowdown started more or less around the global financial crisis. And that's the time when trade credit had dried up. And since then, China is playing or is allowed to play a much smaller role in the global trade. And one hypothesis is that global value chains have saturated and so on. There's a very rich literature around it for those who are interested. But India's numbers are what they are on external trade and exports. So this is when we just condense that period into the last decade and a half. Growth rate was 8.8% prior to the global financial crisis, and it has drifted down to 7% now. I don't know whether I'm taking too long, so please ask me and I can go through it a little faster. I think I've taken a whole lot of time. Shailu?
We have, Poonam, about 10-15 minutes more.
Okay.
10-15 minutes more.
Okay, I'll try to do it in 10 to 12 minutes. Okay. So there's some other features of India's growth process. Some of these I mentioned, but others are important to understand the structural constraints to India's growth. I did mention that it has been more successful in services than in manufacturing. Within manufacturing, again, a rich literature on that. When you compare the size of an average manufacturing firm in India with that of a Chinese firm, or other successful countries, let alone the developed countries, India's manufacturing firm is very small. and it remains small over the course of its life. Which means that if size and competitiveness are directly correlated, then it means that India's firms do not become globally competitive. There has been a very slow transition of workers and families out of agriculture, which is interesting, and which is a huge political economy question as well. That their livelihoods have to be protected, and they do not have any kind of natural social protection because they are based in agriculture, which is subject to shocks. And in recent years, when the growth is slowing down, the services sector, on which India's growth has been dependent, has been losing steam as well. Another feature of this process has been, and Dr. Acharya's presentation was mostly around this, banking sector has remained predominantly government-owned. And again, there is analysis on it. Public sector banks continue to underperform private banks. The entry, for whatever reason, has not been much into the sector. So it's a few firms which have been consolidated recently, which have survived, and which are the ones who are dominating the sector. Recently, there is stress in the NBFC segment as well. Overall, despite the macroeconomic stability, if you do a cross-country comparison, India has high levels of debt deficit and debt servicing for other countries which have a similar market access for their debt in the market. One thing that is something that I have been interested in, FDI share in GDP, or relative to other forms of capital, or relative to the countries which have done well in the past, such as the East Asian countries. FDI inflows in India have not been comparable, and this is something that can really provide a useful policy response in coming years. Trade integration, despite increasing, has been below that of other countries. So this is really a comparison of India's growth model with other countries. Now, as I mentioned, growth has slowed down further, from the 7% average. So 2017-18 was 7%, 18-19, 6.1, 19-20, 4.2, and God knows what kind of a negative number we'll have this year. You all, I'm sure, have been seeing the projections, which are not pretty at all. So now the question is whether these slowdowns have been structural or cyclical. So if you look at the long-term picture, if you look at some of the structural features behind our growth model, I don't think I need to convince anybody that there have been strong structural factors behind the level of growth that we have had. And a number of things need to be done to take it back to 7%, let alone higher levels. Cyclical factors are short-term factors, and they usually are due to a temporary shock, be it on the demand side, be it on the supply side, it could be external, and they require a different kind of policy response. So cyclical factors usually require a short-term but a quick policy response, which usually consists of monetary policy, forbearance, liquidity injection, front-loading fiscal expenditure, exchange rate depreciation, etc. And now one concern I have is that the entire policy space in the last 2 years or so seems to be, at least in the media, seems to be circling around the cyclical response, when there are deep-rooted structural factors behind the growth trajectory we have had. And of course, when you look at a country's growth experience, there can be a combination of both. Cyclical can become structural if it's not addressed in a timely manner. So I'll leave it at that. Let me see if I have to choose what is it that I talk about. Okay, let me quickly discuss this further slowdown to a below 7% level and what is happening. So the slowdown from 8.5 to 7%, or why we are stuck at 7 and now even below 7, they're clearly long-term structural factors. There is a missing generation of reforms, and the recent factors have further contributed to the deceleration below 7%. Balance sheet issues are continuing in the banking sector. There has been risk aversion, partly based on financing issue, but partly perhaps also based on the kind of economic prospects corporates see. A new issue has been the NBFC segment, where some of the funding from the banks diverted in the last few years. Global economic slowdown and economic certainty hasn't happened, and this is all pre-pandemic. Tax administration has become much stricter, which is not conducive to investment, at least in the short run, and some amount of policy uncertainty. Here is a reform timeline, which I will skip and I'll move on. So reforms, actually, let me go back to very quickly mention what do we mean by reform. So, just like you can look at the growth period and you can divide it into different phases, reform timeline can also be divided. There was a period, I would say, a golden period of economic reforms in India from the early 1990s till mid 2000s, where all the logical reforms that a country needed to do at that level of per capita income were done. The impetus was the crisis, the BOP crisis of 1991, but a number of reforms were done. And Dr. Shailu Singh will remember that we, I think, together saw the speech that Dr. Manmohan Singh gave, one of the budget speeches, when some of these reforms were introduced. Second generation reforms, so reform momentum actually slowed down. When India started growing rapidly, somehow the feeling was that now we can sit back and relax, we have enough to redistribute, and that we have arrived on the scene. So the reforms were not kept pace with, or were not continued, in a logical way, the way they should have. Now, there have been some reform impetus in the last few years, GST, IBC, etc. Inflation targeting, in my mind, is an important reform. But these have neither been adequate. There have been implementation issues, and the complementary reforms that one needs are also missing. So overall, the reform momentum, in my mind, has slowed down since the mid 2000s. And if anything, there is a whole lot of emphasis on the cyclical response, as if they can bring back India to a sustainable 7% growth rate. And in my mind, it's not feasible. So what is the right time to implement reforms? Right time to implement reforms is actually when economic outcomes are favorable, because that's when you have the resources to compensate the losers, those who are going to lose from reforms. But unfortunately, that's not when you get the public opinion or political consensus. That happens during hard times, during crisis, as India had during 1991. And another way to push reforms is to delegate some of them to the states. So at some point in time, I had studied state-owned enterprises reforms in China as a part of a larger group. And I realized the way those reforms were carried out and implemented in China was by delegating them to the states, because they have a better understanding of the context, and they have less political pressures. Now, pandemic is absolutely going to disturb India's growth story. We don't know for how long this shock is going to last, and when will the recovery happen. Some recent research shows that irrespective of what is done on the stimulus side, demand is unlikely to rebound fully until the infection itself recedes. And this is done in a very interesting paper at Harvard University. And for those who are interested, I would encourage you to look at this. So what policy space actually do we have currently and has been used? So usually in the IMF, mostly in the IMF and less so in the World Bank, we talk about policy space. So again, when a global report is written, they talk about, or even a country-specific report, that emerging markets need to have policy space. By that, they mean that there should be enough room in monetary and fiscal policy to ease them if there is a shock. Interestingly, in India, we did have that room in monetary policy. and it has reacted in an appropriate and proactive manner. The reaction is comparable to that of other emerging markets. I think just one point I want to make here is that inflation targeting did not at all constrain the Monetary Policy Authority to take that action. There has been regulatory forbearance, which hopefully is temporary and time bound, because we remember the lessons from 2008-9, what it did to the bank balance sheets. Fiscal policy was already stretched, and even then, with whatever stimulus has been announced or not announced, deficit is projected to increase to 10% of GDP, and India's debt is going to increase by 20 percentage points of GDP. This increase is primarily due to the revenue shortfall. So this shock is certainly different from what we had during the global financial crisis. A debt of 90% of GDP is indeed very high. There were studies showing that 70% of debt to GDP ratio was unsustainable, and here we are talking about 90%. So I think I would just like to sum up here, about time. So I think if I want to summarize this presentation, India's long-term growth and potential has been quite promising. My interpretation is that due to several structural factors, growth slowed down to about 7% from a level of about 8.5% in the early mid-2000s. Economic environment was already challenging when the pandemic struck. And in order to provide the policy support, a very fine balancing act is needed. And there needs to be better appreciation for the policy constraint that one operates in. BOP currently is strong, and the monetary policy framework is delivering. Financial sector has been a weak link in India's growth, and the issues have now dragged on for nearly a decade and a half, and it's not good for the growth prospects. Sectoral reforms are important too. Reforms need to be treated as a continuous process. There is no slowing down. As an economy evolves, becomes richer, becomes more complex, the policy frameworks have to evolve accordingly. Fiscal support needs to be calibrated carefully, and it needs to be a more holistic discussion about how far can we go on the fiscal side, but more importantly, how will it be financed and how will it be serviced eventually. But in an op-ed article, I also mentioned that despite all these challenges, some of the underlying, just one second, some of the underlying, just give me a second, please. Yeah. So some of the underlying correlates of growth in India's growth model do not seem dented to me. And these depend again on the size of the country, on demography, on entrepreneurship, the fact that there are inherent dynamics for a country which is still only a lower middle income country. Macroeconomic stability is maintained and so on. But if we are aspirational, we need to address a number of reform issues and policy framework issues. So I'll stop here. Thank you.